Have you ever really wondered how insurance companies actually make money? I mean, it's a strange business, right? They're basically betting on when we'll die, but underneath all of that, there's some really fascinating and pretty cold, hard math. So in this explainer, we're going to pull back the curtain on the actuarial science that literally turns life and death into profit and loss.
Let's just jump right in with a big question. If you have a life insurance policy, is your death a profit for that company or is it a loss? I mean, your first instinct is probably to say it's a loss, right? Of course it is. They have to write a massive check.
Well, like a lot of things in finance, the real answer is a little more complicated. It's not a simple yes or no. You see, insurance isn't just about paying out claims. It's a really sophisticated prediction game. And whether your death helps or hurts their bottom line, it all comes down to the specific kind of game they're playing with your policy.
Okay, let's get into it. At its very core, an insurance company's balance sheet is this constant tug-of-war between two things: their predictions, which they call assumptions, and what actually happens in the real world, which they call experience. And whenever reality, the experience, is different from their prediction, that's where they either make a profit or they take a loss. So to really get a grip on that profit or loss, we have to ask a more specific question. When someone with a policy dies, what is the actual, immediate financial shock to the company? And trust me, it's probably not what you're thinking.
The secret to understanding this is a little concept called the policy reserve. The easiest way to think about it is like a savings account. It's money the insurer has already been putting aside for you year after year, specifically earmarked to cover that big promise they made to your family.
Okay, so that leads to a pretty logical question, doesn't it? If a big chunk of the payout money is already sitting there in that reserve account, what's the real, immediate financial hit the company takes when a claim is made?
This is what actuaries calculate. They call it the death strain at risk, or DSAR for short, and it's actually really simple. You take the full payout amount, then you subtract the policy reserve they've already saved up. Whatever is left over, that's the extra cash they have to find right now. So that number, not the full payout, is their actual immediate risk.
All right, so now we know how to figure out the risk on a single policy. So how does this scale up to tell us if the company is making or losing money overall? Well, it all just boils down to a simple comparison: what they thought would happen versus what really happened.
And this is where two really important terms come into play. First, you've got the expected strain. That's the total amount of that at-risk money the company predicts it's going to have to pay out over the year. Then you've got the actual strain, which is what they really paid out based on the real number of people who died. The difference between those two numbers, well, that's the whole ballgame.
Now, all this theory is great, but the best way to really get it is to just see it in action. So let's walk through a classic example, straight out of an actuarial textbook, to make this crystal clear.
So picture this. An insurance company has a group of 10,000 policies. Each one pays out $50,000 on death. The company looks at all its data, its fancy charts, and makes a prediction. They expect a mortality rate of 1%. That means they're bracing for 100 of these people to pass away this year. Okay, so based on that prediction, the company's expected strain for the year is $5 million. Simple math, right? 100 predicted deaths times that $50,000 at risk for each one. This is the amount they have budgeted to pay out. But of course, life doesn't always go according to plan. At the end of the year, the accountants look at the real numbers. And it turns out reality was a little bit kinder than their prediction. Only 89 people died, not the 100 they had planned for.
So what does that mean for the money? Well, the company's real cost, their actual strain, ended up being only $4,450,000. That's simply the 89 people who actually died times the $50,000 payout for each.
And here's the aha moment. The company budgeted for $5 million in costs, but they only spent about $4.5 million. That difference, that $550,000, is what they call a mortality profit. They made $500,000 simply because fewer people died than their models predicted.
Okay, so that seems pretty straightforward, right? For life insurance, fewer deaths equals profit. But this is where the story takes a really fascinating and frankly completely backwards twist.
To get this twist, you have to know about the other side of the insurance coin. We've been talking about life assurance, which pays out when you die. But an annuity, something like a pension, is the total opposite. It's a promise to pay you an income for as long as you live.
And because that payment is triggered by survival instead of death, the entire financial logic gets flipped on its head. With annuities, having fewer people die than you predicted can actually be a financial disaster.
So let's go back to our textbook for the flip side of this. Imagine a different group. This time, it's 5,000 pensioners. The company predicted that about 10 of them would pass away during the year. But just like in our first example, reality was kinder. Only 9 of them died.
The result? A mortality loss of over £200,000. Why? Think about it. That one extra person who survived still needs to get their pension check. The company has to keep paying them month after month, year after year, an ongoing cost they hadn't budgeted for. As the textbook puts it, pretty bluntly, the loss arises because fewer people died than expected.
So, now that we've seen both sides of this weird financial coin, we can finally put the whole picture together.
And this table right here, this sums it all up perfectly. For a life insurance policy, if fewer people die than you predict, you pay out less in death benefits. That's a profit. But for an annuity, if fewer people die, you're stuck paying more in survival benefits, and that's a loss. It all comes down to one simple question. Does death trigger the payment, or does survival? So when you zoom out, you realize that the entire insurance industry is basically a prediction business. They take all of our individual, totally unpredictable risks, they pool them all together into one giant group, and then they make a very, very educated bet on our collective future, how many of us will live and how many of us will die. Their profits and their losses, they all live in that tiny gap between their prediction and what really happens. So now that you get the math behind this business of life and death, think about the insurance products you might have. Which side of the bet is your insurer quietly rooting for?